Hello and welcome to ForeTrade. In this video, I'll be taking you through what you need to know to understand trading in the financial markets. In order to have the confidence to make trading decisions, it's important to have knowledge of how things work and some of the terminology. It can sound complicated, but is usually far simpler than it sounds. In the world of finance, the products we deal with are called contract for difference, or CFDs. A CFD is a contract between two parties, a buyer and a seller. It is only the price of the instrument that you are trading with. This is a benefit, since nobody has to own anything in order to trade. Trading CFDs is not the same as owning shares. Buying a share means you are counting on the fact that the price will go up. With CFDs, you trade on whether you believe the price will go up or down. That's called double-side trading. There are other advantages trading CFDs has over traditional instruments such as shares. Another advantage the market has is that it's open 24 hours a day and 5 days a week, Monday to Friday. You can trade anytime you want during the working week. Forex has a trading volume of some $5.3 trillion a day. It's a huge market that a lot of people participate in. But despite the size of the market, be aware that not all Forex CFD trading companies are regulated or have the same standards. ForeTrade, for example, possesses a license from the British Financial Conduct Authority. But many companies in the industry do not have any license. The issue of trust and legal authorization is important to consider when trading with hard-earned money. So let's cover some basic terms that we will often read about or hear us talking about, which you might not be clear on. I'll begin with some of the simpler terms that many traders assume that people know. A financial instrument. An instrument is a tradable asset. For traders, in plain English, an instrument is any item you want to trade with. It can be gold, Bitcoin, or the euro-dollar currency pair. Currency pair. A currency pair is one currency's value in relation to one other currency, like the euro-dollar currency pair. If you trade on the euro-dollar and believe that the value of the euro will go up against the dollar, then you would execute a buy order. If you think it will go down, you should execute a sell order. Going long or going short. Going long or a long position is taking a buying position on a stock, commodity and currency, expecting the price to go up. To go short is to take a selling position, expecting the price to go down. The key here to avoiding any confusion is the first letter in short is S, like sell. Bullish and bearish. A bullish market is a growing one where prices are rising or are expected to rise. A bull is a trader who believes that prices will rise. A bearish market is the opposite. Prices are trending downwards or are expected to. A bear is a trader who is pessimistic and believes that prices will fall. A good way to not get these terms mixed up is to consider how you would expect a bull to charge forward and attack, knocking their prey upwards. A bear will attack by attacking its prey with its paws downward. Pivot point. A pivot point is part of technical analysis and is an indicator used to identify the trend of a market or instrument. It's based on the average of high, low and closing prices from the previous trading day. Spread. You may have noticed that the buying price and selling price isn't exactly the same when trading. This is because of the spread. This is the commission you pay as a currency trader. Double-side trading. This basically means you can trade either way, entering into a buying or selling position. This is different from shares, for example, which you buy counting on the fact that price will go up, as I've already mentioned. The economic calendar. The economic calendar should be an important part of every trader's considerations. It lists economic events that will influence prices of your instruments in a certain direction when data is released. One example would be the Federal Reserve or Bank of England announcing interest rates, which will affect the price of currency pairs. A stop loss is a market order set in advance by you to close the position of an unprofitable instrument when it reaches the price you've set. It's used to limit your losses. It can be a useful tool, but when the market is highly volatile, a stop loss may not work, so caution is advised. Take profit is similar to the stop loss in that it automatically closes the position of a financial instrument that you previously specified. But in this case, you will be closing the position of a profitable instrument once it reaches the price you set. Obviously, you would limit your profits like this if you feel that the market might be about to reverse and turn against you. A pending order. This differs from a normal instant execution order in that you set the price you want to trade with the instrument in question. At the moment the price reaches the level you set, your buy or sell order will be executed automatically. A resistance level is a price ceiling which the market may have difficulty rising above and breaking through. A support level is the opposite, a price floor which the market may find difficulty breaking through below. Volatility. This is a term we often use to indicate that a financial instrument's price may fluctuate or change in a more extreme way than usually expected. The potential for profits are higher, but the chances of losses are greater too. High volatility is a signal for cautious traders to use great care when trading. Rollover. This is a predetermined date at which a trading contract is rolled over, that is, automatically renewed. Leverage is using borrowed capital to potentially increase profits or potential losses that can be made. If an instrument you trade has a leveraged ratio of 1 to 200, for example, you can trade to a value 200 times greater than your available capital. The benefit is that you don't need to put as much money into your trading account to stand a chance to make good gains, but you should be aware that the market can turn against you. Margin. Margin is how much a person must deposit in order to hold a trading position. If your account falls below the minimum margin requirement, a margin call will be made, requiring that additional funds be deposited. More information on this can be found in the support menu by clicking on Policy and Procedures and then scrolling down to Margin Policy. We have done a number of videos covering many of these items in more detail and how they are used, so please watch these for further information. But if you want to quickly look up terms you are not familiar with, please go to ForeTrade's website's Education section and then click on Glossary of Terms. At this point, let me quickly take you to our website to briefly show you our online trading academy in the Education section, which will provide you with tools that will help you to trade more successfully. In this section, you can download ebooks. Advanced courses for beginners and advanced users can be found here. Trading videos that explain things simply can be watched here. If it's day trading strategies you're after, we have you completely covered. Lastly, you can find our glossary of terms that I referred to earlier on. We hope that you found this video useful. Please join us again at ForeTrade soon.